In a major policy shift, the Indian government has authorized 100% foreign direct investment into the domestic insurance sector. The automatic route is now completely open. There is one explicit carve-out. Foreign investment in the Life Insurance Corporation of India remains strictly capped at 20% under the 1956 LIC Act. Opening a domestic market to total foreign ownership requires an equivalent upgrade in oversight. International capital demands predictability, and a rapidly expanding retail market requires robust consumer protection. This massive influx of global capital directly precedes the most aggressive regulatory overhaul by the Insurance Regulatory and Development Authority of India in almost a decade. More capital means a massive expansion in policy issuance. To protect this growing retail policyholder base from systemic risk, the IRDAI is completely re-architecting its grievance oversight mechanisms. The specific regulatory instrument driving this change is the Draft Insurance Ombudsman Amendment Rules of 2025. Under the Legacy 2017 framework, the Ombudsman operated as a flat, isolated, and largely conciliatory fact-finding body. Disputes were resolved at the local level, and its awards were considered final and binding on the insurer. This diagram contrasts the two systems. On the left, the closed-loop 2017 conciliation model. On the right, the 2025 draft rules establish a strict multi-tiered adjudicatory model. A new oversight tier at the top introduces a formal appellate authority, placing localized ombudsman decisions under the direct scrutiny of the IRDAI. This profound structural redesign defines a completely new legal and financial reality for handling retail insurance disputes in India. The draft rules target the front end of the grievance lifecycle by aggressively compressing administrative timelines. Complaints must now be officially registered within 1 working day of receipt. This document shows the proposed Rule 14.6. It mandates a comprehensive digital infrastructure overhaul, requiring an end-to-end online complaints management system. Looking closer, the platform explicitly allows for Aadhaar-enabled authentication, ensuring rapid biometric verification of complainants. Physical access is also expanding. The rules mandate the establishment of an ombudsman office in every state capital and union territory. To manage this volume, the Council for Insurance Ombudsman is granted the authority to dynamically load balance online complaints across different offices based on real-time capacity. The result is a highly authenticated, high-speed intake engine. It systematically eliminates the administrative delays and procedural bottlenecks insurers previously used to stall dispute resolution. The structural core of the 2025 overhaul is the insertion of Rule 17a. This document displays the exact wording establishing the new appellate authority under the IRDAI. By allowing appeals against local awards, Rule 17a brings the era of ombudsman finality to an end. Crucially, this new appellate layer is not an independent arbitration body. The benches are constituted directly by the regulator itself. This creates an immediate operational risk for insurers. Every rationale recorded by a local ombudsman during an initial dispute is now subject to rigorous, formal appellate scrutiny. Consequently, frequent appeals by a single insurer are no longer isolated regional data points. The appellate authority acts as an intelligence pipeline. It aggregates retail grievances into systemic data, making an insurer's operational habits fully visible to the IRDAI. To understand the financial teeth of these draft rules, we must accurately define consequential loss. This refers specifically to the indirect financial impact a business suffers following a covered physical event. On the left, direct loss covers immediate physical damage, like a factory fire. On the right, consequential loss tracks economic fallout, plummeting revenue, ongoing salaries, and supply chain disruptions. While physical assets can be repaired, this compounding loss of cash flow threatens survival. For a commercial policyholder, consequential loss is their largest financial vulnerability. Historically, it was also a complex metric for a localized retail grievance mechanism to adjudicate. The 2025 draft rules address that complexity by granting the Ombudsman enhanced punitive powers to penalize insurer actions deemed unjust, arbitrary, or mala fide. In the draft rules, the enhanced penalty framework allows the Ombudsman to award an additional penalty up to 100% of the original claim amount. This is capped at 20 lakh rupees for consequential loss, alongside a separate 1 lakh rupee penalty for mental harassment. This creates a severe cascading liability. An insurer acting in bad faith could be forced to pay the base claim, plus the 100% penalty, plus the consequential loss cap, plus the mental harassment fee, alongside statutory interest. Arbitrary claims handling now triggers a codified, compounded financial liability matrix, punishing bad faith practices by design. Historically, the Ombudsman system was funded on a proportionate, industry-wide basis. The financial burden was shared evenly, regardless of an individual insurer's misconduct. This document shows the proposed Rule 12-2. It outlines a new funding framework that incorporates the operational expenses of the newly created appellate authority. The Council for Insurance Ombudsman now factors the specific number of non-complied awards into each insurer's required financial contribution. This penalty matrix feeds directly into the funding mechanism. As an insurer increases its number of non-complied awards or uses arbitrary delays, their mandatory operational contribution rises. The IRDAI has engineered a sophisticated regulatory trap. An insurer's poor compliance track record is effectively taxed, impacting their operational bottom line long before any formal regulatory sanctions are levied. The conciliatory era of the insurance ombudsman is over. Legal counsel and risk managers must now treat every grievance proceeding as a direct precursor to regulatory action. Insurers must initiate immediate internal audits of all claims escalation protocols. Any process that could be legally construed as arbitrary or unjust must be eliminated. Furthermore, digital infrastructure must be upgraded immediately to ensure strict data handling compliance for the new Aadhaar-authenticated grievance portal. In an era defined by massive foreign capital and relentless oversight, mastering this adjudicatory architecture is the baseline requirement for operating in the Indian market.